At higher income levels, taxes don't get complicated because of secret rules. They get expensive because of overlooked details inside the system. A system where RSU withholding interacts with your marginal bracket, where quarterly estimates determine whether you owe penalties, where cost basis reporting can double tax you, where credits phase out without you noticing. Inside a system like that, small misalignments compound. And when no one is coordinating those moving parts, that's when high-income households end up writing five-figure checks they didn't expect. In this video, I'll show you how to know whether your RSUs and bonuses are being under-withheld before April surprises you, how to determine if you should be making quarterly estimated payments and exactly how much, and how to avoid the reporting and timing mistakes I regularly see cost high-income households 5 figures a year. Before we get into the 10 mistakes, you need to understand something. At lower income levels, taxes are linear. You earn, you withhold, you file. But once your household income crosses $250,000, especially with bonuses and equity, it becomes a relay race. Payroll handles W-2 withholdings. Your brokerage reports stock sale. Your company administers RSUs or options. Your CPA files a return. Each runs their leg, but no one is holding the baton. No one is coordinating how RSU withholdings affect your brackets, how vesting impacts estimates, how capital gains trigger net investment income tax. Individually, each part looks fine. But when the handoffs aren't clean, the baton gets dropped. And that's when penalties show up. That's when underwithholding happens. That's when you write a check you didn't plan for. This video is about making the handoff clean. Mistake number 1, underwithholding on your RSUs and bonuses. I can't tell you how many times I've heard this. My RSUs vest, taxes are withheld automatically. I figured that meant I was covered. That assumption makes sense. It just isn't accurate at higher income levels. Most bonuses and RSUs are federally withheld at 22%. But if your household income is $300,000, $400,000, $500,000, you're not in the 22% bracket. You're likely in the 32%, 35%, maybe even the 37% bracket. That difference doesn't show up in the moment. It shows up in April. Withholding is not your tax rate, it's just a prepayment. So if $300,000 of RSUs vest and 22% gets withheld, but your real marginal rate is 35%, that gap can easily turn into a $30,000 to $45,000 surprise. Here's the fix. Mid-year, not in December, run a projection that includes your vesting schedule and bonuses. Then make a decision. Do you increase payroll withholding, or do you make targeted estimated payments tied to those vest dates? Either is fine, but assuming the default withholding is enough, that's a mistake. And if you receive RSUs or large bonuses, this applies to you. Now here's where the next issue usually shows up. You fix withholdings, but forgot about the timing of payments. At this income level, your pay isn't smooth. It spikes. RSUs vest in June, a big bonus hits in March. You sell stock in October. Your income moves in waves. The IRS doesn't mind waves, it minds underpayments. And this is where safe harbor rules matter. If you don't pay at least 100% of last year's total tax, 110% at higher incomes, or 90% of the current year's liability, you can owe penalties. I see people do one of two things. They ignore estimates and get penalized, or they massively overpay just to be safe. Neither is strategic. The smarter move, look at where your income spike happens. Large vest in June, adjust in June. Big capital gain in October, adjust in Q4. And remember, increasing payroll withholding late in the year is often cleaner than quarterly checks because it's treated as if it happened evenly all year. Mistake number 3, double taxing RSUs because of cost basis errors. Here's a scenario I see every year. Someone sells vested RSUs. The cash hits their account. The 1099B comes from the brokerage, and they assume it's correct. But here's what most people don't realize. When your RSUs vest, the fair market value on that vest date is already included as income on your W-2. You already paid ordinary income tax on it, but many brokerage statements report a zero cost basis or an incomplete one. So when the return gets filed, the IRS system thinks the entire sale amount is capital gains. You get taxed twice. Let me give you an example. Say $200,000 of RSUs vest at $50 per share. That's 4,000 shares. That full $200,000 is on your W-2. You later sell all shares at $55. Your real gain is just $5 per share, $20,000 total. But if the basis isn't adjusted, the system treats the full $220,000 as gain. That's not a small mistake. That's a 5-figure overpayment. And the frustrating part, it's completely avoidable. The fix is simple but intentional. You reconcile vest prices. You compare them to the 1099B. You adjust basis on Form 8949 if needed. Mistake number 4, selling ESPP shares or options without understanding the tax timing. I see this one happen with good intentions. Someone says, I've got too much company stock, I should diversify. That's responsible thinking. But with ESPPs and options, timing changes the tax outcome. Most ESPPs give you up to a 15% discount. That discount can receive favorable tax treatment, but only if you meet the holding requirements. Generally, 1 year from the purchase date, 2 years from the offering date. Sell before that, it becomes a disqualifying disposition. And that 15% discount, which you thought might be taxed at capital gains rate, shows up as ordinary income instead, at 35% or 37% depending on your tax bracket. That's a very different outcome. With stock options, the mechanics shift, but the theme is the same. You exercise, you hold, you assume tax is simple. It isn't. Equity compensation has rules layered inside of rules. The mistake isn't selling. The mistake is selling without understanding which tax bucket that sale falls into. Before you hit sell, you should know, is this a qualifying or disqualifying? Is this ordinary income or capital gains? Is this triggering AMT? Mistake number 5, triggering AMT when exercising ISOs. This is one of the most misunderstood areas of high income tax planning. I exercise my ISOs, there's no tax until I sell them, right? Under the regular tax system, mostly yes. Under the alternative minimum tax system, not necessarily. When you exercise ISOs and hold the shares, the spread, which is the difference between your strike price and the fair market value, becomes an AMT adjustment. Let's say your strike price is $10 and the stock is trading at $60. That's a $50 spread per share. Exercise 10,000 shares and you've just created a $500,000 AMT adjustment. That can generate a 6-figure tax bill before you've sold anything, before you've created liquidity. Now, that's where stress starts. ISOs don't eliminate tax, they shift which system calculates it. So before you exercise, especially in size, you need to run an AMT projection. You might also consider spreading exercises across multiple years. You evaluate whether a same year sale makes sense to avoid AMT exposure. Mistake number 6, forgetting the 3.8% net investment income tax. A lot of high earners think long-term capital gains are 15% or 20%. And that's technically true until your income crosses certain thresholds. If your modified adjusted gross income exceeds $200,000 if you're single, $250,000 if you're married filing jointly, an additional 3.8% net investment income tax applies. So now your 20% capital gains is treated at 23.8%. On a $500,000 gain, that's a $19,000 difference. Mistake number 7, leaving tax advantage space unused. I'll see high earners investing aggressively in taxable brokerage accounts while not fully maxing their 401k or skipping HSA contributions, or not evaluating backdoor Roth options. In 2026, contribution limits are $24,500 into a 401k, $7,500 into an IRA, $4,400 individual HSA, or $8,750 for a family. If you're in a 35% marginal bracket, maxing a 401k alone can reduce federal tax by over $8,500. Mistake number 8, assuming you don't qualify for credits. High earners tend to self-disqualify. I make too much, that doesn't apply to me. Sometimes that's true, but not always. Many credits phase out gradually. They don't disappear overnight. The fix here is simple. You don't assume, you calculate. Mistake number 9, misunderstanding the SALT deduction rules. The SALT deduction rule is capped. There's nothing to plan around. That's not quite true. For 2026, the SALT cap is $40,400, but it begins phasing out around $550,000 of income and can reduce back toward $10,000 as income approaches the $600,000 range and above. That spike doesn't just increase federal tax, it can indirectly reduce how much state tax you're allowed to deduct federally. Mistake number 10, poor capital gains timing and no lost harvesting. Most people sell investments for reasonable reasons. The stock's up. They want to rebalance. They need liquidity. All fair. But taxes don't care about your reason. They care about timing. Sell inside 1 year and gains can be taxed at your ordinary income rate. Cross the 1 year mark and now you're in the 15% to 20% range, plus net investment income tax if applicable. And then there's loss harvesting. If you're realizing gains but don't intentionally realize losses, you're leaving offsets unused. Losses offset gains dollar for dollar, but only if you harvest them. And that brings us back to the bigger picture. The common thread in all 10 of these mistakes isn't complexity, it's coordination. The tax code penalizes underpayment. It does not reward overpayment. So the real question is this: is your money working for you or sitting with the IRS months early? Click right here if you're interested and want to know if you are overpaying on estimated taxes, and I'll show you how to dial this in without guessing.